It is still some time before the market can fully allocate resources. After all, there will be a more intense war between the Kuomintang and the Communist Party after the victory of the anti-Japanese war. It now appears that the government's control over monetary capital is gradually weakening, and various types of financial institutions and non-financial enterprises are entering a state of melee over monetary capital. In this situation, there may also be variations and risks in the fundraising between legal entities, such as those named as legal persons or natura, persons running the red light in fundraising, and private equity investments going bankrupt in large areas during industry downturns, when commercial banks, insurance companies, and pension funds become a trend to intervene in private equity funds. Various institutional barriers will be broken when the interfaces between state-owned enterprises, foreign enterprises, and private enterprises are no longer distinct, and each type of enterprise has its own way to obtain wealth that adapts to it, freely entering and exiting the capital market. The era of free allocation of China's currency and capital market will come. The Eighth Route Army era of capital market is coming. The new partnership law has been officially implemented since June 1, 2007. Which specifically adds the limited partnership clause and allows corporate partnership, has created a new channel for venture capital VC and private equity investment PE. Legally, it opens the way for private equity investment, and senior officials have also frequently talked about it. Vice President of the Central Bank Gu Xiaoling stated that China should currently improve the equity trading market and vigorously develop private equity investment funds. Bean believes that in the current situation in China, developing the capital market is more important than developing the equity investment market for unlisted enterprises, which means vigorously developing private equity funds and investments. Private equity funds have long been on the edge of the law and are suspected of illegal fundraising. Does this recruitment indicate that illegal fundraising has become history? The identity of private equity funds changes with the changing financial environment in China. On the surface, excess liquidity pushes the development of the stock market has been stimulated, and the prosperity of the stock market has provided a relaxed environment for corporate financing. However, in reality, China's listed companies are mainly large state-owned enterprises, and the vast number of private small and medium-sized enterprises do not have the opportunity to go public and cannot enjoy the benefits of excess liquidity. Moreover, the prosperous stock market has absorbed a large amount of retail funds, which were originally intended to enter small and medium-sized enterprises through private lending, resulting in increased financing difficulties for these enterprises. The more excess liquidity, the more difficult it is for small and medium-sized enterprises to raise funds. Breaking this cycle will rely on private equity investment, which becomes a medium connecting small and medium-sized enterprises and private funds. Therefore, private equity funds and investments have become a dual need for economic development and capital market development. Yes. With the continued development of private equity investment, the power of the state in currency allocation and regulation will change. Transformation. At present, the money market is mainly composed of banks and the stock market. Bank funds are not only directly controlled by interest rates and reserve requirements but also influenced by window guidance. The listing and circulation of stocks are also subject to administrative allocation, so the financing of their funds is still controllable, as evidenced by the 5.30 sharp drop. However, private equity funds and investments are subject to minimal state intervention, and the state cannot regulate their interest rates and returns, nor can they determine their quantity and scale. It is even more difficult to regulate overseas funds, and due to the private nature of these funds, they are detached from formal banks and securities markets, making it difficult for the state to regulate them indirectly. Therefore, at the social foundation level, the state will no longer be able to exercise the allocation power of monetary capital, resulting in a significant increase in the degree of marketization of monetary capital. The characteristics of private equity funds are high risk and high return. The success rate of foreign venture capital investment does not exceed 30%. And one's success will bring returns tens or hundreds of times. China's industry has just started, and it may not only be affected by its own risks, but also be subject to sudden intervention from national policies and local governments, which increases the opportunities and traps for private equity funds in China. These opportunities and traps will breed more new types of enterprise models, surpassing traditional investment banking and venture capital enterprise models. It can be called a new type of investment bank. Private equity investment abroad is purely a market behavior, and the exit channel for venture capital is mainly through corporate listing. In recent years, companies that have become popular, such as Shanda, Baidu, and Trip, are all supported by foreign PE and mainly through overseas investment, going public as an exit channel for venture capital. Local private equity investment, whether in terms of funding sources or investment projects, is still more or less related to the government. For example, the early establishment of Shenzhen Venture Capital and He recently established Bohai Industrial Investment Fund can all be considered as government-led private equity investment categories. This is very different from the classic meaning of investment banks, but many local governments in China are adopting this system for operation. For example, Jiangsu has proposed to build China's Temasek. The Temasek model is where the government only appears as an investor, without interfering with actual investment projects. Moreover, unlike foreign private equity investments, China's investment hotspots are no longer limited to overseas capital markets. Go to industries that are more favored, such as TMT, telecommunications, technology, and media. Why of them are sunset industries abroad? while in China they may be high-growth industries. For example, chain economy hotels are the most boring industry in mature markets, but China's Home-Inn Express hotels are listed overseas with a P/E ratio of over 60 times. 99% of enterprises in Zhejiang are small and medium-sized enterprises. These small and medium-sized enterprises are not high-tech industries, but they make good profits but face financing difficulties. This is also an important stage for private equity investment. At present, overseas investment funds have diversified their choices for the Chinese industry and are no longer solely focused on the Internet. Private equity funds not only changed the financing pattern of Chinese enterprises, especially small and medium-sized enterprises, but also contribute to China's capital market. The field will have a significant impact. In 2006, the Chinese stock market was booming, with the active members being the National Army, mainly public funds and state-owned enterprises. The large number of listings of state-owned enterprises improved the overall quality of listed companies, and the frenzy of public funds directly promoted the prosperity of the stock market. The dominant force in the development of the stock market in 2007 was the Boxer Rebellion, which refers to individual investors. The funds of individual investors are almost twice that of institutions, and their profit margins are also higher than those of institutions. Public funds face challenges such as redemption pressure and investment transparency, while retail investors face difficulties such as information asymmetry and weak risk resistance. The 5.30 crash said widespread distress for retail investors, while institutions successfully escaped. In front of foreign invaders, the National Army and the Boxer Rebellion were defeated one after another. It was the Eighth Route Army and the guerrillas who could really fight a protracted war. The Eighth Route Army and the guerrillas, which are dominated by private funds, will become the main forces in the capital market in the future. Private funds absorb the advantages of public funds and retail investors, but without too many constraints, and can be done in a large scale, even larger than public funds. The famous Blackstone Inc. in the United States, as well as the famous Quantum Group of funds and Tiger Management, are all private funds. The Eighth Route Army era of capital market is coming. These private equity funds themselves are alienated, and their emergence will also change the operational status of China's securities market. Unlike blind investment by retail investors, some newly opened retail investors only buy stocks on the trading limit or stocks below 10 yuan. Private equity funds cannot only focus on speculating in junk stocks without affecting the market index, but also diversify their investment. More importantly, private equity funds can eat all the upstream and downstream, participate in both the industrial projects of listed companies and the stock trading in the secondary market, and truly achieve the borderless between the virtual economy and the real economy. In terms of the initiation and establishment of private equity funds, The illegal fundraising mentioned at the beginning of the article may still be an important channel, as it reflects US market demand. Of course, this fundraising is different from the recent illegal fundraising of Zhejiang Ben's group Ying towards natural persons. As a result, the new type of private equity funds are playing a marginal role, being suppressed and on the boundary line of development. Neither illegal fundraising nor governance will easily withdraw from the historical stage. Private equity funds and private equity investments will change the allocation of monetary capital in China. But we need to make monetary capital. Treating foreign investment as a raging beast will make immeasurable historical mistakes regarding global foreign direct investment (FDI) in 2007. There were serious disagreements in the reports released by the two institutions according to data from the United Nations Conference on Trade and Development. Global FDI reached a record high of $1.5 trillion in 2007, with 2/3 in developed countries and 1/3 in developing countries. The United States led with $193 billion, followed by the UK with $171 billion, and France with $123 billion. China is still the leader in developing countries on the contrary. According to data from consulting firm OCO Global, although global FDI increased in 2007, it was still less than $1 trillion. While China surpassed the United States as the most favored foreign direct investment destination with a $90.4 billion investment attraction. How to interpret two sets of data and two conclusions. In the era of capital factors, the differences in FDI data first reflect the following issues. Firstly, the ranking of investment attraction is based on a manifestation of the country's ability to attract foreign investment and its trends. It is evident that different institutions have different judgments on China's performance in this regard. 2. Looking back, foreign investment has a Matthew effect. Inconsistent plus irons add some variables to the choice of foreign investment destinations in the future. 3. The concept of a virtual economy with financial civilization determines its attractiveness and even a country's position in international economic activities. The moment is coming to test the emerging markets and China concept. Secondly, the data fight is related to the new trend of global utilization of foreign investment. International experience shows that utilizing foreign investment, the approach is related to the stage of economic development. In the early stages of economic development, there are bottlenecks such as production technology, management experience, and overseas markets. And direct investment that solves these difficulties has become the focus of utilizing foreign capital. With the increasing maturity of industry and the expansion of domestic and foreign markets, indirect investment portfolio investment is not subject to direct investment regulations. To whom do companies entrust money entering 2008? Chinese enterprises not only fully enjoy the fruitful results of 30 years of reform and opening up, but also face unprecedented challenges, some confusion. On the one hand, the economic prosperity has brought excess liquidity, which is mainly reflected in the large amount of capital accumulated in the hands of low-value-added export processing enterprises such as textiles and shoes, as well as the excess capital brought to enterprises by the capital market explosion, and the withdrawal capital of untraded shares and enterprises. On the other hand, the situation has undergone a sudden change, with the continuous appreciation of the RMB, rising labor costs, and the adjustment of export tax refunds superimposed. The transition from hot to cold in the real estate and stock markets has forced enterprises to abandon their original production methods and investment digestion channels. As a result, wealthy enterprises suddenly have no direction and are forced to seek non-traditional financial management methods. At the same time, financial civilization has impacted the Chinese coast more and more, monopolizing venture capital VC and private equity at its forefront. Investment PE has caught the attention of investors, attracting billions or even tens of billions of converted capital, excess capital, and exit capital, with the wealth creation effect of several dozen to 20 times. Especially since the implementation of the newly revised Partnership Enterprise Law in June last year, there have been at least hundreds of VC and PE companies operating in the Jiangsu and Zhejiang regions alone. However, with the failure of Donghai Venture Capital, the first private PE in Wenzhou, and the issuance of the guiding opinions on the transfer of restricted stock of listed companies by the China Securities Regulatory Commission, the future of enterprises entrusting money to PE and VC remains uncertain. For one thing, Chinese-style PE itself cannot escape the fate of excessive hype and burning money on portal websites back then. In the United States, PE is an efficient factor integrator, is a professional who is proficient in finance and possesses solid skills in enterprise operation and business expansion. Under the premise of low market efficiency in other investment and ownership models, they successfully reduce. The end of the investment banking era. The fifth wave of the subprime mortgage crisis has hit. Does the 8-day period from September 14 to September 21, 2008 mark investment banking the demise of the line? Lehman went bankrupt. Merrill Lynch sold, and Goldman Sachs and Morgan Stanley became regulated banks. This is part of the most disastrous transformation of investment banks since the Glass-Steagall legislation in 1933 created them. In the future, familiar names such as Bulk Bucket, the label of a large investment bank, an elite investment bank in the United States, will need to be redefined, and year-end rankings will be revamped, while clients and management will need to adapt to new basic rules. However, despite these changes, if investment banks survive the current crisis, they may also exist as familiar faces within the new organization, and the effectiveness of the investment banking industry will also be enhanced. In a sense, there won't be much change, The company we see as an investment bank has become a large gold mine-run comprehensive group. After Morgan Stanley merged with consumer finance company Tianhui in 1997, it was no longer an independent investment bank. After Goldman Sachs went public in 1999, it went beyond the scope of investment banking by expanding trading and principal investment activities. By 2007, less than 15% of its earnings before taxes came from investment banking. In fact, pure investment banks have long ceased to exist. Incorporating some well-known old brands into banks and redefining some other brands will hardly affect customer service or market share. As for the performance of investment banks, whether these financial groups align their business with other businesses is just a symbolic issue. However, the market turmoil will bring opportunities for other institutions to enter the investment banking business field. In recent years, the financial services of human capital companies, hedge funds, and investment banks are showing a convergence trend. Goldman Sachs, which has a private equity and hedge fund business, is no more like an investment bank than the acquiring company Blackstone. Blackstone also has consulting experts and alternative investment funds. The ambiguity of these differences has led alternative investment companies into the due to the limitations of small scale and poor flexibility. It has become highly favored. There has been a shift from greenfield investment building a new enterprise to greenfield investment and merger and acquisition, merging or acquiring an existing enterprise, which combines direct investment with new indirect financing methods, especially utilizing the international capital market. A clear example is that foreign investors have established private equity funds targeting China overseas through joint ventures, investing in equity of Chinese enterprises through acquisitions and other forms. Foreign mergers and acquisitions blur the boundary between direct and indirect investment, inevitably leading to statistical differences. From the historical data of most countries and institutions, foreign mergers and acquisitions, as a new form of utilizing foreign capital, have become an important component of FDI. FDI has received much attention, indicating that attracting investment is still a booster for the rapid development of the world today. Whether it's developed countries. As a developing country, foreign investment is still one of the most effective means to create jobs. According to the statistics of the Bank of France, the amount of foreign investment and mergers and acquisitions in France in 2007 reached €100 billion, basically consistent with the data of the United Nations Trade and Development Commission, creating more than 30,000 jobs. The third best year since 1993. In this way, whether it is the statistical results of the United Nations Conference on Trade and Development or the conclusions compiled by the consulting agency OCO Global, China's problem is not whether the foreign investment utilized in 2007 was comparable or even surpassed by developed countries, but whether China still regards foreign investment as a monster to some extent. since the beginning of the new century. Due to the frequent occurrence of foreign capital mergers and acquisitions in China, its share of China's total FDI has reached about 20% from 5.5% in 2000 to 2005. Finally, when Carlyle wanted to become the owner of XCMG in 2006 and SEB in France wanted to acquire Supoa, a big debate about beheading foreign capital was triggered. The threat of foreign capital has spread from the daily chemical industry to the equipment manufacturing industry, and recently to the grain and oil processing industry. At the same time, various external restrictions policies have emerged, such as the introduction of 3 policy provisions in 2006 that involve strengthening the management of foreign mergers and acquisitions. In 2007, the catalogue for the guidance of foreign investment industries was revised to include all investment activities in the real estate industry in the restricted category, and significant